Used car sales revving up, expected to hit record levels.
Now, with a surge in a certain type of car sale, more and more buyers finding big savings right now. So what's fueling the buyer's market? ABC's Marcy Gonzalez on getting the most for your money.
What if the car sitting in your driveway lost thousands of dollars in value overnight? That isn't a distant possibility, it's a reality, now taking shape across the United States. A tidal wave of used vehicles, more than 5 million in total, is preparing to hit dealership lots nationwide. This isn't just a temporary market dip, or the kind of correction we've seen in previous years. It's a collapse built on layers of financial missteps, rushed policies and corporate decisions that converged into what many insiders are calling a perfect storm. For years, consumers were told that cars could be investments. Dealers and lenders painted a picture of vehicles as assets that could hold or even increase in value. But that illusion is crumbling. What's left is a market facing unprecedented levels of repossessions, rental fleet liquidations, and electric vehicle lease returns, all hitting at the same time. The consequences won't just be felt by car dealerships and manufacturers. Ordinary Americans who bought during the price bubble are facing crushing debt and negative equity, while corporate giants are quietly positioning themselves to take advantage of the chaos. This report takes you through the critical pieces of this collapse, step by step, from the bubble years of the pandemic to the legislative loopholes that accelerated the downfall, from the repossession crisis devastating families to the corporate sharks circling distressed assets. The story is far larger than a sudden dip in used car prices. It's a systemic failure with ripple effects that could alter the automotive industry for years to come. But before we break down how the collapse is unfolding today, we need to go back and understand how we arrived at this tipping point in the first place. Real quick, if you're into videos that cut through the noise and break things down clearly, go ahead and hit that like button. It helps more people find this. And if you're not subscribed yet, now's a good time. We've got more deep dives coming your way. Also, drop a comment and let me know what you think. I'd love to hear your take. Now onto the video. During the pandemic, cars underwent a transformation that defied common sense. Vehicles, long understood as depreciating assets, began to behave like gold. Supply chain disruptions shuttered factories and strangled output. In 2020, production of new vehicles plummeted to just over 13 million units, the lowest levels since the Great Recession. What had once been ordinary family sedans and pickups suddenly became scarce commodities, and scarcity always drives frenzy. Families that once expected to negotiate discounts now face bidding wars. Buyers paid thousands above sticker prices simply to drive something off the lot. Even modest vehicles like Toyota Camrys, Honda Accords and Ford F-150s saw values climb month after month. Pickup trucks that would have sold for $35,000 before the pandemic suddenly commanded prices of $50,000. Consumers were told that cars could be flipped for profit, that owning a vehicle was no longer just about mobility, but also about building equity. Cheap credit poured gasoline on the fire. The Federal Reserve slashed interest rates to near zero in response to economic instability, and auto lenders stretched loan terms to 7 years or more. This made soaring vehicle prices appear manageable. At least on paper, monthly payments seemed affordable, even as buyers signed contracts for sums far larger than they ever imagined spending on transportation. By 2021 and 2022, the used car market had completely detached from its historical norms. Families who normally might have purchased a reliable 3-year-old sedan suddenly paid record-breaking sums for it. Rental companies, unable to replenish fleets due to limited new car supply, hoarded vehicles they would normally have sold. Dealers marked up prices to capitalize on desperation, while consumers convinced themselves they were investing in assets that would hold value. It was an illusion, one built on scarcity, cheap credit, and psychological manipulation. Cars don't appreciate in value under normal conditions, but as long as supply remained constrained and demand high, the bubble continued to inflate. Like all bubbles, though, the conditions that sustained it couldn't last forever. The stage was set for a collapse. All it would take was a shift in supply and demand dynamics, combined with the weight of unsustainable financing, for the illusion to shatter. That shift began with a single word most car buyers dread: repossession. Repossession isn't new. Every economic downturn leaves behind households unable to keep up with their car payments. But what's happening now is different in both scale and intensity. In 2024 alone, an estimated 1.73 million vehicles were repossessed across the United States. That's the highest number since the fallout of the 2008 financial crisis. The human toll is staggering. Behind every repossessed vehicle is a family struggling under the weight of financial stress. For a single mother in Michigan, 2 missed paychecks were enough to trigger the loss of her only means of transportation. For a delivery driver in Texas, missing his van meant losing not just a car, but also his livelihood. These aren't isolated cases. They represent millions of Americans for whom a $600 to $700 car payment became the breaking point in an era of rising rents, medical bills, and food costs. Those debts linger for years, wrecking credit scores and draining savings. For lenders, repossessions mean recovering assets at a fraction of their book value. For families, They mean financial devastation that extends well beyond the loss of a car. But repossessions don't just hurt individual households. They also flood the wholesale market with inventory. Every car hauled away by a tow truck finds its way to auction lanes within weeks, where it competes with thousands of others just like it. The surge in supply pushes auction prices down sharply. Retail values follow, as dealers can only charge what buyers are willing to pay. In a market already oversaturated with vehicles, repossessions are a fire hose of supply that accelerates the collapse. Yet repossessions are only one of the rivers feeding into this flood. Another, far larger, is flowing from the companies that once controlled the rental counters at airports across the country. The rental car industry has always been a critical, if quiet, part of the used vehicle supply chain. Companies like Hertz, Enterprise, and Avis regularly cycle millions of vehicles through their fleets, selling them into the used car market once they reach a certain age or mileage. Under normal conditions, this flow of vehicles is steady and predictable, absorbed easily by dealerships and auctions. The conditions are no longer normal. Hertz, once seen as a pioneer in the transition to electric mobility, made headlines in 2021 with its bold order of 100,000 Teslas. It was a gamble intended to position the company as a leader in the EV rental market. By 2024, it had become a nightmare. Electric vehicle values plummeted faster than Hertz could depreciate them, leaving the company with hundreds of millions in losses. In early 2024, Hertz admitted defeat and announced it would dump 40,000 EVs, mostly Teslas, into the market. That move wasn't a gradual release. It was an avalanche. Auction houses that once welcomed late-model rentals suddenly found themselves with rows upon rows of nearly identical vehicles. Buyers, recognizing Hertz's desperation, bid low. Prices for competing EVs plunged. As a result, dragging down values for other models in the process. Hertz's liquidation was only the most visible example. Across the industry, rental giants are trimming fleets and unloading inventory at unprecedented speeds. In a typical year, about 2 million rental cars enter the used vehicle pipeline. Today, that pace is even faster, and it's filled with cars just 1 or 2 years old, the very vehicles that would normally command a premium. With rental fleets liquidating, repossessions spiking, and consumer demand weakening, the market was already on edge. But the real spark that turned a shaky situation into a full-blown crisis came not from consumers or corporations, but from a single line of legislative fine print. Every financial collapse has a trigger point. For the used car market, one of the most overlooked yet devastating catalysts came not from consumer behavior or corporate mismanagement, but from a line of fine print buried deep within the Inflation Reduction Act. On the surface, the legislation was designed to push America toward a cleaner, greener future. It offered generous tax credits to encourage the adoption of electric vehicles, reducing the cost burden on households and nudging them toward greener transportation. But lawmakers, perhaps unknowingly, created a loophole that would end up distorting the market in ways no one fully anticipated. The detail was small but powerful. Leased electric vehicles would qualify as commercial sales. That classification meant banks and automakers, not just consumers, could claim the $7,500 federal tax credit tied to EV purchases. In practice, this allowed lenders and car companies to structure lease deals in ways that passed much of the savings to customers. Suddenly, monthly payments for EVs dropped by hundreds of dollars almost overnight. The impact was immediate. Vehicles that seemed out of reach for the average consumer in 2021 and 2022, like Teslas, Ford Mustangs Mach-E, and Hyundai Ioniqs, suddenly became affordable through lease contracts. What might have cost $600 or $700 a month could now be driven for $400 or less. Leasing surged. In 2022, only about 15% of new EVs were leased. By 2025, that figure had skyrocketed to nearly 2/3 of all EV sales. Half the time, it looked like a success story. Automakers were moving more EVs off lots. Consumers felt they were getting a deal. Lawmakers pointed to rising adoption as proof that incentives were working, but beneath the surface, the seeds of disaster were already sown. Unlike purchases, leases are temporary. Vehicles leased in 2023 and 2024 would inevitably return in just 2 to 3 years. And because so many EVs had been leased in a compressed timeframe, the returns would arrive in equally compressed waves. This wasn't a gradual shift the market could absorb. It was a ticking time bomb. Compounding the problem was the pace of technological advancement. Unlike gasoline-powered vehicles, which retain value for years, electric cars depreciate rapidly due to constant upgrades in battery technology and frequent price cuts by manufacturers. A consumer leasing a $50,000 EV in 2023 might see that vehicle worth less than $35,000 by the time it returned to the market 2 years later. Multiply that across hundreds of thousands of leases, and you have a systemic shock no market could sustain. This fine print loophole didn't just encourage EV leasing, it supercharged it by turning what should have been a gradual market evolution into a tidal wave of vehicles all scheduled to return within a short window. The legislation loaded the cannon. All that was left was to wait for the first batch of lease returns to hit, and when they did, the flood began. The numbers tell the story more clearly than anything else. In 2025 alone, more than 123,000 leased EVs are scheduled to return to the used car market. By 2026, that figure leaps to nearly 330,000, and by 2027, a staggering 650,000 late-model EVs, most less than 3 years old, will be dumped into an already oversaturated market. That means, in just 3 years, more than 1 million nearly new EVs will flood auctions and dealer lots, regardless of whether demand exists to absorb them. Why does this matter so much? Because unlike traditional vehicles, EVs don't follow predictable depreciation curves. Their values collapse at a much faster pace. There are 3 main reasons. First, rapid technological change. Each year brings significant advances in battery range, charging speed, and overall performance. A car that looked cutting-edge in 2023 can feel obsolete by 2025, especially when newer models come with cheaper price tags and longer warranties. Buyers naturally gravitate toward the latest offerings, leaving recent models stranded in the used market. Second, price cuts by automakers. Tesla, for instance, has aggressively slashed prices multiple times in the last few years to stimulate demand and fend off competition. While this strategy may boost new sales, it devastates used values. A car purchased for $50,000 new might compete with a brand new version priced at $42,000 just a year later. No rational buyer will pay near new prices for a used version. Third, lingering concerns about battery longevity. While EV technology has advanced rapidly, consumer skepticism remains. Stories of expensive battery replacements and uncertainty about long-term performance weigh heavily on resale values. A 2-year-old EV may carry the stigma of being a risky buy, especially when warranties start to expire. All of this means that EVs coming off lease aren't returning as valuable assets, they're returning as liabilities, poised to drag down market prices for both electric and gasoline-powered cars alike. The oversupply of EVs adds another layer to an already collapsing market flooded by repossessions and rental fleet liquidations. Dealers and auctions aren't prepared for this volume. Parking lots can't stretch to infinity. Wholesale buyers are cautious, knowing values will fall further with each passing quarter, and retail consumers are waiting on the sidelines, anticipating bigger discounts if they simply delay their purchases. This waiting game creates a vicious cycle. Prices fall. Buyers wait. Prices fall again. Industry insiders have dubbed this the EV time bomb. It's not just about the sheer number of vehicles coming back, it's about their unique inability to hold value in a market already drowning in supply. For families who thought they were stepping into the future by leasing an electric vehicle, the reality is grim. For the industry, it's an unprecedented glut that will fundamentally reshape the automotive landscape. To understand just how damaging this collapse is for dealerships, you need to know how their business model actually works. When you walk onto a dealer's lot and see rows of shiny cars, it's easy to assume the dealer owns them outright. But in reality, nearly all of those vehicles are financed through a system known as floor plan credit. Dealers borrow money from banks or automakers to stock their inventory. Every day a car sits unsold, the dealer pays interest on that loan. When inventory used to move quickly, sometimes in a matter of days, the system worked. Carrying costs were manageable and dealers made a profit on each sale. But in today's collapsing market, cars sit unsold for weeks, even months. Each day adds interest, eating into whatever profit margin the dealer hoped to make. Consider a dealership holding 200 vehicles. If each one carries an average floor plan interest of $15 per day, that's $3,000 in interest, piling up daily. In a month, the dealership has paid nearly $100,000 just to keep cars parked on the lot. And those costs don't stop on weekends or holidays. The interest meter ticks relentlessly, whether cars are selling or not. Faced with this math, many dealers have no choice but to cut prices aggressively, often selling at a loss, just to stop the financial bleeding. Others hold out, only to be punished when auction values fall further, dragging retail prices down with them. It's a lose-lose scenario. Dealers either take the hit now or face an even bigger hit later. The consequences are severe. Thousands of small-town dealerships, the backbone of the American auto market, are being pushed to the brink. For many, one bad quarter could be fatal. Those that survive often do so by consolidating with larger dealer groups or selling out entirely. But the landscape is shifting away from independent family-owned dealerships toward massive corporate conglomerates that have the resources to weather prolonged losses. Compounding the crisis is the breakdown of traditional valuation systems. Guides like Kelley Blue Book or NADA, once seen as reliable indicators of a car's worth, now lag reality by thousands of dollars. Dealers using these outdated benchmarks are finding themselves upside down, holding inventory worth far less than what the books suggest. Buyers, aware of the collapse, are negotiating harder, demanding discounts well below guide values. For dealers, it feels like fighting a war on two fronts: the relentless pressure of floor plan interest on one side and collapsing consumer confidence on the other. The system that once allowed them to thrive is now crushing them. And as dealers struggle for survival, the ripple effects spread further through the economy, affecting lenders, automakers, and consumers alike. In normal times, the value of a car is relatively predictable. Buyers, sellers, and lenders rely on guidebooks like Kelley Blue Book or NADA to establish baselines. Dealers use those values to set prices, lenders use them to calculate loans, and buyers use them to decide whether they're getting a fair deal. But when markets spiral out of control, those traditional benchmarks collapse, and that's exactly what's happening now. At auctions across the country, cars are no longer selling based on guidebook values, they're selling based on desperation. Dealers, lenders, and rental companies with mounting inventories are being forced to accept whatever bids they can get, often thousands below book value. A car that Kelley Blue Book still pegs at $25,000 might cross the auction block at $19,000, and the winning bidder knows it could fall even further in just weeks. This rapid reset of pricing is known as price discovery, and in stable markets, it's a normal function of supply and demand. But when discovery happens in panic conditions, it creates a cascading effect. Buyers hold back, expecting lower prices tomorrow. Sellers slash aggressively to unload vehicles before they depreciate further, and guidebooks lag behind reality, creating a disconnect that fuels even more distrust. Dealers are caught in the middle. If they price cars according to the guidebooks, buyers laugh them off the lot. If they price them to reflect current auction conditions, they're forced to take heavy losses. Many choose the latter, reasoning that losing $2,000 today is better than losing $4,000 tomorrow. The result is a race to the bottom, where prices are determined not by intrinsic value, but by sheer urgency to move metal. The psychological toll on consumers is equally important. During the pandemic bubble, buyers scrambled to grab cars before prices rose further. Now the opposite mindset dominates. Shoppers walk into dealerships knowing values are falling, and they're willing to wait it out. Every week of hesitation is rewarded with deeper discounts. This shift in psychology, known as the deflationary mindset, paralyzes demand, which only worsens oversupply. Even automakers are feeling the impact. When used prices collapse, new car sales suffer too. Few buyers want to commit to a $45,000 new SUV if they can watch nearly identical models sell for $30,000 used just down the street. Leasing new vehicles also becomes more difficult, as lenders factor in the falling residual values. What used to be a predictable cycle of new cars feeding into used sales is now broken, replaced by chaos. In this environment, auctions have become the battlefield where values are rewritten weekly. Wholesale buyers, online platforms, and corporate dealers treat each sale as a test of the market's new floor price, but the floor keeps dropping. To small dealers and ordinary consumers, it's devastating. For well-capitalized corporate giants, it's an opportunity, and they are moving quickly to seize it. In every economic collapse, there are winners. While small dealers, strapped consumers, and desperate lenders drown in red ink, larger players with deep pockets are circling the market like sharks. Their strategy is simple: buy distressed assets cheap, consolidate power, and wait for stability. When the dust settles, they emerge stronger than ever. Take the example of Carvana and Vroom, two online car platforms that once seemed like overhyped tech startups. Their rapid growth during the pandemic left them burdened with debt and unsold inventory. But in today's collapsing market, their model gives them an edge. With advanced logistics networks and the ability to move cars quickly across regions, they can scoop up vehicles at distressed auction prices and flip them to buyers nationwide. Where a small-town dealer sees a liability, these giants see arbitrage. Large dealer groups are also exploiting the crisis. Conglomerates like AutoNation and Lithia Motors, with hundreds of locations and access to cheap financing, can weather short-term losses that would crush independence. Many are quietly acquiring smaller dealerships, folding them into their networks, and consolidating control of regional markets. Each collapse of a family-owned lot is another opportunity for these giants to expand. Even automakers are stepping into the game. Some manufacturers are buying back their own vehicles at auction to prevent values from falling even further. Others are forming partnerships with online platforms to manage used inventory directly, cutting out middlemen altogether. By doing so, they not only stabilize their brands, but also position themselves to profit when the market eventually recovers. Private equity firms and hedge funds too are watching closely. History shows that distressed industries attract investors looking for bargains. Dealership real estate, once a stable but unremarkable asset, is suddenly available at fire sale prices. Investment groups with billions at their disposal are snapping up properties and franchises, betting that consolidation will pay off when values rebound. For these corporate players, the collapse isn't a crisis. It's an engineered opportunity. Their scale allows them to absorb losses, the financing shields them from immediate pressure, and their strategy ensures they'll dominate once the chaos ends. But while corporations reposition for profit, ordinary Americans are bearing the brunt of the collapse. They don't have the luxury of waiting years for recovery. For millions of car owners, the crisis is personal, immediate, and financially devastating. For car buyers, the most painful part of this collapse isn't watching dealer lots overflow or auction prices tumble. It's looking at their own loan balances and realizing they're trapped. Across the United States, millions of households are stuck in negative equity, owing far more on their vehicles than those vehicles are worth. On average, the gap is more than $11,000 per borrower. That means someone who financed a used SUV for $35,000 in 2021 may find it worth only $24,000 today, yet their loan balance still sits at $35,000 or higher. There are only two options, and both are brutal. Selling the car requires writing a check to cover the difference, often thousands of dollars most families don't have. Keeping it means continuing to pay hundreds of dollars per month for an asset that loses value every week. The situation is especially dire for households who stretched themselves thin during the pandemic bubble. Many extended loan terms to 7 or even 8 years just to make monthly payments manageable. Now they're locked into long-term commitments on vehicles worth far less than the financing suggests. The dream of upgrading to a newer car in a few years has evaporated. Instead, families are saddled with underwater loans that act like financial anchors. Interest rates have made the problem worse. The Federal Reserve's aggressive hikes have pushed auto loan rates to highs not seen in decades. The average used car payment now exceeds $733 per month, a record figure that stretches budgets already battered by inflation in housing, groceries, and healthcare. For many, that payment represents the single largest monthly expense after rent or a mortgage. Subprime borrowers, those with weaker credit, are hit hardest. Lenders, wary of falling collateral values, are demanding higher down payments and stricter qualifications. This locks out many would-be buyers, shrinking demand further and feeding the downward spiral in prices. At the same time, those who manage to secure financing are often burdened with interest rates so high that affordability becomes questionable. The psychological toll is heavy. Car ownership, long considered a cornerstone of American independence, is increasingly seen as a financial trap. Younger consumers in particular are beginning to question whether owning a car is worth the risk at all, especially in urban areas where alternatives exist. For millions of others, however, a car isn't optional. It's a necessity for commuting to work, accessing healthcare, or transporting family members. For them, the collapse means being stuck with crushing payments and evaporating equity. In the short term, there are no easy answers. Bankruptcy offers one escape, but it carries long-term consequences. Loan modifications are rare in the auto industry compared to housing, and simply walking away leaves borrowers exposed to repossession, lawsuits, and damaged credit. As consumers grapple with this financial trap, the broader market feels the strain. Weak demand from ordinary buyers ensures the glut of vehicles remains unsold, and that, in turn, creates even more pressure on dealers, lenders, and automakers to slash prices further. The spiral continues, with no clear bottom in sight. For buyers, investors, and even small dealers still clinging to survival, the collapsing used car market isn't just a catastrophe, it's also a crossroads. The landscape is shifting beneath everyone's feet, and the choices made in the next few years will determine who sinks and who adapts. For everyday buyers, the first lesson is patience. Falling prices may look like good news, but rushing into a purchase today could still mean overpaying tomorrow. Industry insiders believe values haven't yet reached the bottom, particularly for electric vehicles. With hundreds of thousands of EVs scheduled to return from leases between 2025 and 2027, the downward pressure on prices will continue. Savvy buyers know that waiting even just 6 months could mean saving thousands. That said, cash is king. Buyers who can afford to purchase outright will be in the strongest position. With lenders tightening credit and raising interest rates, financing has become increasingly burdensome. Those who can sidestep loans entirely not only avoid sky-high payments, but also gain leverage in negotiations. In a market where dealers are desperate to move inventory, showing up with cash can secure discounts that finance buyers simply can't match. For investors, the playbook looks different. While families see collapsing values as a nightmare, private equity firms and well-capitalized corporations see opportunity. Distressed dealerships, under pressure from floor plan debt, are being acquired at bargain prices. Commercial real estate tied to automotive retail is suddenly available at discounts not seen in decades. Investors willing to take the long view, enduring volatility now in exchange for consolidation later, are moving aggressively. The key is timing. Jumping too early risks catching falling knives as values continue to slide. Waiting too long, however, means missing the bottom and competing with other opportunists once stability returns. The most successful players will be those who read the signals carefully, balancing patience with decisiveness. For smaller dealerships, the choices are brutal. Many will close. Some will sell to larger groups, trading independence for survival. Others may pivot, focusing on niche markets, specialty vehicles, service operations, or buy here, pay here financing models, carve out a space in a hostile environment. The common thread is adaptation. The days of relying on inflated margins and steady new car pipelines are gone. Only those willing to reinvent themselves will endure. For everyone, the overarching lesson is that the automotive market is entering a new era. The bubble years taught consumers and businesses alike a dangerous myth that cars could defy gravity and act as appreciating assets. The collapse has shattered that illusion. Going forward, caution, flexibility, and realism will define the survivors. The tsunami hitting America's used car market isn't just about numbers. It's about people, policies, and power. More than 5 million vehicles are flooding dealerships at once, fueled by a perfect storm of repossessions, rental fleet liquidations, and electric lease returns. Each stream of supply has its own story. Families losing cars to repossession, corporations like Hertz dumping EVs in desperation, and lawmakers unintentionally unleashing a flood of vehicles through legislative fine print. Together, they've created an oversupply so massive that the industry's traditional rules no longer apply. For small dealers, the collapse is existential. Floor plan loans are crushing balance sheets, while price discovery at auctions punishes those who hesitate. For consumers, it's deeply personal. Millions are trapped in negative equity, making payments on cars worth far less than their loans. For corporate giants and investors, however, the chaos represents an opening, an opportunity to consolidate, acquire, and prepare for dominance once stability returns. The lesson is clear: cars were never investments. The bubble of 2021 and 2022 convinced millions otherwise, but the laws of economics eventually reassert themselves. Scarcity drove values up, and oversupply is now driving them down with equal force. The future of the automotive market will not be defined by illusion, but by fundamentals, supply, demand, and the willingness of consumers to adapt. As the dust settles, the industry that emerges will look very different. Smaller dealers may vanish, leaving large corporations in control. EVs, once hailed as unstoppable, will face a harsher reality of depreciation and market skepticism. Consumers, scarred by the collapse, may grow more cautious, wary of financing long-term loans on fast-depreciating assets. The winners will be those who recognize the truth early, that cars cannot defy gravity. The losers will be those who clung to illusions of permanent appreciation. What's left is a market fundamentally rewritten, one that serves as both a cautionary tale and a stark reminder that in every boom, the seeds of the next bust are already planted. Once again, thanks for watching this video. If you got something out of this, hit that like button and make sure you're subscribed so you don't miss the next one. And hey, let me know your thoughts in the comments. Agree, disagree, or something in between. I'd love to hear it.